right, so good afternoon and thank you for joining us for What's New for 2022 Tax Law Changes for the upcoming filing season. I am Gary Dehart, publisher of Insightful Accountant and Tax Practice News and host of today's fairly short 30-minute webinar. Our speaker is Christine Gervais. Christine is the technical editor of Tax Practice News, CEO of the Department of Tax, and a nationally recognized speaker who provides education to other CPAs on how to best serve clients, as well as instruction on a wide variety of topics for business owners on how to maximize success. Christine has been a CPA for over a decade. She has a master's degree in accounting and is currently pursuing her PhD in accounting as well. So a couple of housekeeping items. CPE is not available for this session. If you have any questions, we ask you to put them into the questions panel, and the link to the recording can be found on our YouTube channel, and I will put that in the chat. And Christine also, I believe, has already placed the slide deck in the chat for you as well. And lastly, you will receive an email from us with a link to the YouTube page, as well as to a box folder with that presentation if you don't download it today. So Christine, thank you so much for joining us. Happy holidays, and I will turn this over to you.
Thank you so much. So yes, we will send out those slides. It's taking a minute right now for me to upload that, but don't worry, we will make sure that you get copies of the slide deck from this presentation. If you don't download it, like Gary said, we will make sure that that gets sent out after the presentation as well. So just give me 1 second here. I'm going to get this started and share my screen so that you can all see it. All right. And I'm just going to take one more second to make sure that I pull up the chat and the Q&A, and I will keep it over here. So if at any point during the presentation you have a question or anything that I can specifically answer for you, feel free to pop that into the chat or the Q&A, and I will try and keep an eye on those as we're kind of going through the slides and make sure that I get any questions answered for you. So yes, as Gary said, thank you so much for having me. My name is Christine Gervais. I am currently the CEO of the Department.Tax. We provide white label outsourced tax services to other professionals like yourselves. And we're going to get right into it because we do only have 30 minutes today. So just some quick notes. I'm going to dive into a little bit more detail related to some of these changes, but to kind of just fire some things off at you right off the bat, we are coming into what I lovingly refer to as tax planning season right now, and that's all of us having just finished getting through all of our extension deadlines, jumping right into the last 6 weeks of the year, trying to help all of our clients to plan for year end and those last fourth quarter estimated payments that are going to need to be made in January, and last minute decisions that are going to be needing to be made from a strategic planning perspective related to their taxes. So again, like I said, we're going to dive into what specifically some of these changes are, but things for you to start being aware of, especially as you're having those planning conversations. What a lot of these are, I kind of am referring them to as sneaky tax law changes this year. I think many of us have PTSD after the last couple of years of law changes happening at the end of the year, or like last year in the middle of tax season, things changing as we're preparing returns. We don't necessarily know whether or not that's still going to happen in the next few weeks. It doesn't seem like it's going to be quite as much on the table as it may have been in the last couple of years. But the reason that some of these are a little sneaky and can kind of pop up on you in doing your tax planning at the end of the year is that a lot of the changes that are happening as of the end of 2022 is that we're going to see provisions expire. So instead of seeing new things come on board, we're going to see things that were in place for 2021 and we're going to see them expire, affecting your tax planning for 2022. So things like we did not extend the child tax credits. So there was a bump to those last year. We'll talk about that. We're not going to extend the bump to the earned income credit. I'll also talk about that. Income limits adjusted for capital gains taxes, residential energy credits increase. We're going to lose the mortgage insurance premium deduction. That's another one that just simply was not extended. No more above the line charitable deduction, simply not extended. So those things that were on those returns last year are simply going to disappear. And we'll kind of talk about those, but I want you to be hyper aware that as you're doing projections for your clients, these things that may have been on the returns last year are not going to continue. Yep, I see a couple of you asking about slides and handouts. So again, I will get those posted into the chat. They're still trying to upload. So we'll work on that before the end of the presentation, but if you're not able to download them live, Gary is going to send them out. So if you don't have them, no worries, we will make sure that you get them, okay? All righty. So kind of getting into some more meat and potatoes. So things that you want to actually look at, the child tax credits drop back down to $2,000 per child for children ages 16 to 17 and $3,600 for each child under the age of under the age of 6, so younger than 6, so 5 years old and under. This is going to be smaller than what those credits were for 2021. Also keep in mind that during 2021, a lot of your clients probably received those advanced child tax credits. That was a fun and interesting excursion for those of us who are preparing returns with how inaccurate a lot of those letters were. And all of the holding up of the refunds. So thankfully, we didn't advance those credits again for 2022, but also need to be aware that those credits are dropping back down. So when you are preparing those projections for clients that have children, dependents on their returns, be aware that especially if you're still using this year's software to run your projections, that those amounts are going to be different. The former age limits return. So last year, children over the age of 17 still had some expanded child tax credits available for them. That is not the case anymore. So essentially after the age of 16, that credit is going to phase out, especially if the children are not full-time students. And then the requirement for earned income comes back for this credit to be refundable. So 2021, if parents did not have a certain level of earned income, they were still allowed to receive a fully refundable child tax credit. That is no longer the case for 2022. So we have to have working parents or a working parent on the return to meet that earned income requirement before these credits are refundable. And then child and dependent care expenses. These are going way back down. They were expanded a lot in 2021. There wasn't an income requirement or I should say the income requirement was significantly higher. The deduction itself was significantly higher. For 2022, completely phased out after income of 15,000. So a lot of clients that received a deduction for dependent care expenses on their 2021 return are going to get no benefit from that in 2022. So these are just things that I think we kind of automatically see them come through on the returns. We expect to see them, but being aware that these amounts are going to be significantly decreased for 2022, you're for sure going to have clients that are going to be impacted by this. They might be right on the line of certain amounts of taxable income. So just be hyper aware of these changes and running your projections and make sure that you're using the correct amounts for these. When you start to add them up, if you have a set of parents that are impacted with multiple children across these credits and these deductions, you're going to have significantly depressed refunds from the previous year. Some other things to keep in mind. So the earned income credit, the age limits go back to pre-2021, and the amount of the credit gets cut in half. So what happened in 2021 is we significantly expanded the age limits of this. It was previously that it was a smaller age bracket that could take this earned income credit. We weren't necessarily applying it to things like retirement income. So that gets completely contracted back and the credit is smaller. So very much like the child tax credits, where if we're not paying attention to this, we can be running projections assuming that that credit is going to be similar to last year. A lot of the times we assume that these credits will at least stay the same, if not increase. That is not the case for the earned income credit in 2022. The capital gains tax is actually one of the only ones that gives you a boost. This slide is titled Tax Bites, so everything else is taking a chunk away from us, but the capital gains tax, the rates right now are staying the same. That was definitely something that was discussed from a political perspective for quite a bit about whether or not the capital gains rates were going to be adjusted in any sort of way. That's not something that's passed in legislation yet, although I know it's still a conversation. So we'll see if that's something that actually does get back on the chopping block before the end of the year. But what they did instead was adjusted the income limits to be larger, which helps because if you have a client that was previously limited or their previous capital gains rate was going to be in the 20% bracket versus the 15% bracket simply because of their adjusted gross income, that may not be the case anymore. They expanded that income upwards a little bit. So the income limit to switch from the 15% or from the 0 to the 15% is now higher. Mortgage insurance premium deduction. So that is just on the mortgage insurance premiums, not on the interest itself, but that deduction is eliminated for 2022. And I just saw a question come through. Can it still be used on the home office deduction, or is that phased out also? I think that's a great question. I don't know as though they've issued specific guidance on that. My take on that would be that the home office deduction is separate consideration than Schedule A deduction. So mortgage insurance premiums have been phased out for Schedule A deductions, but I've always treated home office as really a different animal entirely because your clients can obviously take things like utilities, liability insurance, homeowners insurance on that home office deduction calculation that they can't take on Schedule A. So absent specific guidance on that, my approach to it would be that those mortgage insurance premiums can still be allocated as part of the home office deduction. It just would not be something that would flow through to Schedule A. So I would only include that on your home office calculation. I wouldn't include it as something that would then, be allocated back to Schedule A. Perfect. Let me just make sure that I mark those as done so that I know that I answered you. Great question. Absolutely great question. Charitable contributions above the line. So if you remember last year, for those of us who were not necessarily taking itemized deductions on Schedule A, I know many of the 1040 clients that we work with now are not itemizing their deductions simply because the standard deduction is so much higher than it used to be. And we're also still limiting the amount of state and local income taxes that can be deducted on Schedule A. By the way, just a little plug to go back and watch the recording from last month. We specifically did a webinar on the deduction of state and local income taxes for any of your clients who are pass-through business owners. There is a little bit of a loophole for that state and local income tax deduction if you have clients who are pass-through business owners. The rules of who can take advantage of that loophole is very specific, but we do have a recording from last month on that webinar, specifically how to look at your client list and figure out who might be able to take advantage of that, which of your clients might benefit from it. So if that's something that you want to take a look at, please go back and watch that recording. It should certainly be helpful for your pass-through business clients. But for the rest of your clients who are not filing Schedule A and itemizing their deductions last year, like I said, they still have the opportunity to take either a $300 on a single filed return or a $600 above the line deduction for charitable contributions on a married filing joint return last year. That completely gets eliminated for 2022 as well. It was not extended. So there's a lot of things here that simply are just not going to carry through from 2021. And I'm sure all of you as tax preparers, you can start to see how that's going to pop up and cause some unfortunate pain and agony for some of our clients. These things are things that are just, they're not clear changes because they were benefits that were available to them last year that are simply going away. A lot of them didn't necessarily adjust their payroll withholdings or adjust their estimated tax payments to take these things into account. But when you add them up, if you had a client that had the increased child tax credit, had the increased earned income credit, had the above the line charitable deduction last year, and is now losing the benefit of all of those, that's going to be the tune of several $1,000s. So you could very much have clients that had larger refunds last year or who had refunds last year who are going to end up owing because of the differences in these items expiring. Now is a great time to make sure that we're taking a look at that and having those conversations, because I'm anticipating a lot of our 1040 clients kind of being caught off guard by this. Deborah, great question. Thank you for asking. Where can you find the recording for the state tax deduction for pass-through entities? So you should be able to find those on the Tax Practice News website. I can pop that into the chat in just a minute too. I'm unfortunately a terrible multitasker, but we'll make sure to post the link on the website. And Gary posted the link to the YouTube page in the chat, if you can see that. So that YouTube page isn't just specific to this recording, it will have last month's recording as well. So we'll make sure that we get that up for you. Okay, just give us a minute to switch to the next slide. The improvement to the residential energy tax credit, this one is exciting. This one has gone back and forth as, being taken away, expiring, and not extended for several years now, and thankfully they continue to add to it. So the 2022 credit increase, the Inflation Reduction Act that was just passed a couple of months ago, that raises the credit from what would have been, I believe, 26% to 30% on qualifying energy efficient properties. So this is residential. So these are your clients' personal homes. This is not commercial, although there are still some business specific energy efficient property improvement things. Gary, thank you. Deborah, if you want to just look in the chat, I believe Gary posted the link directly to that YouTube recording for last month's webinar for you. Some additional property qualifies this year, starting in 2023. So this is something to take into account for your clients who are tax planning starting next year, looking for ways to reduce their tax liability. So starting in 2023, property placed into service that is battery storage technology will be eligible for the credit. So that is not property that has been eligible in the past. For 2022, if your clients put in anything electric, water heating, temperature control systems that are qualified energy efficient, and they're based off of solar, wind, geothermal fuel. You can see it right here on this slide. Those energy efficient improvements on their residential homes will qualify for the expanded 30% credit for 2022. So thankfully that one is a little bit of a boost. Great question to be asking your clients as you're preparing their tax returns. It's usually on most organizers, but just reminding them that if they did any of this, we're seeing a lot more clients that are doing solar improvements, that they have that available to them. And hopefully that expansion will offset some of the other items that are expiring. Some other miscellaneous changes to be aware of. These ones don't affect quite as many clients, but things to just kind of keep in mind in case you do have any clients that might be impacted by this. 2021, we still allowed for some self-employed sick leave credits. So that meant that if you had a sole proprietor who was sick, this was still related to the pandemic relief that was going on. If I, as a sole proprietor, had to leave my business or wasn't able to work in my business for an extended period of time due to illness, I was allowed for some sick leave credits on my income tax return last year. That is not available anymore for 2022. So just kind of keep that in mind for any of those clients who may have used that to their advantage. It's not something that is going to be a continuing benefit for them. This one, the 1099K, I think that this is going to probably impact a lot more small business clients, sole proprietors, especially than it has in the past. And so this is certainly something that you want to start to keep in mind as you move into tax preparation, probably more just for us from an internal operation standpoint of making sure that we're collecting all of these before preparing this return, because these are going to be new documents that we're receiving this year that we haven't necessarily had to look for in the past. But the 1099K is now going to be issued for any amounts processed over $600, where it was previously $20,000. So this is for any of your clients who essentially are being paid via credit card. So 1099K comes from credit card processors. So this is going to be a form that a lot more, especially your solo practitioners, receive this year that were not necessarily receiving them in the past, especially if they had smaller businesses that were obviously doing less than $20,000 a year in credit card payments. That $600 limit is extremely low. So please anticipate, especially like I said, on some of those smaller solo practitioners, those Schedule C returns this year, you're probably going to be looking for these forms where you may not have had to collect them in the past, and anticipate that you're going to want to make sure that your client's income tax returns, their Schedule C, is linked to having received these, where you, again, would not have necessarily had to do that in the past. But preparing to make sure that we include those so that you're not getting notices about them not being included on the return. So just a good note to keep in mind, especially where you have any clients that are filing a Schedule C, worth it to ask this question as you're starting to collect their documents at the beginning of tax season. Hey, did you process any payments from your clients this year via credit card, so that you know whether or not you should be waiting for this form to come in. They should be processed at the end of January, just like the rest of the 1099, so that you shouldn't hopefully have to be waiting for them, but wanting to make sure that you're looking for them coming in. A couple of other just miscellaneous things that don't affect everybody, but doubling the deduction for teachers. So teachers who are spending their own personal money on supplies for their classroom previously could only take up to $300 worth of deductions for supplies that they personally paid for. So that doubles for 2022 to give them a little bit of a boost. So any teachers that you're preparing individual income tax returns for, worth it to ask them whether or not they had that much in personally paid for supplies. The lifetime estate and gift tax exclusion is now $12 million. Again, another political item that it will remain to be seen whether or not it stays that way. But for 2022, that is up about another $1 million from where it was last year. So those estate and gift tax exclusions are still very high for 2022. Just something to keep in mind in your tax planning conversations, especially if you're doing estate and trust work. There's not a lot of corporate changes and not a lot of corporate expiration, like expiring provisions for 2022. A lot of the changes this year relate to the individual returns. Couple of corporate tax law changes, again, not expecting these to impact a large number of the clients that many of you may be working with, but corporations earning over $1 billion in net income could face the new alternative minimum tax. It's 15% above and beyond their regular corporate tax. So that is something that is brand new, has not appeared in the past, came in as part of the legislation that was passed this year. However, it was anticipated that it was only going to impact about 1% of corporations in the United States. So kind of unusual, but just so that you're aware. Also, the excise tax on stock buybacks only applies to publicly traded companies. So I know a couple of people that I had conversations with were asking specifically about plans to address this. Unless you are preparing returns for a publicly traded company, this is not going to apply. So privately held corporation returns that you're preparing, there's no excise on those stock buybacks. And this isn't really a change per se, but again, Tax Practice News just posted an article on this a couple of weeks ago. If you didn't read it, you can go check out the details on the website. I know that the article is still up there, but the IRS has issued some expanded guidance on our much hated K2, K3 forms. So if you prepared any pass-through entity tax returns last year, you felt the pain and agony of the K2, K3 form coming into play on those 2021 pass-through returns. The IRS didn't actually issue the forms until about halfway through tax season, and then issued them with very little guidance as to how we were supposed to prepare them. So that caused a lot of stress. I know that it extended the filing season for many of us. We had to extend those pass-through returns back in the spring and wait for more guidance to be issued. So the IRS has issued more guidance on those. They unfortunately did not change what many of us feared to be true, and that is that if you have shareholders or partners as part of that pass-through return who are filing Form 1116 on their personal return, meaning they are personally taking credits for foreign income taxes paid, that these K2 and K3 disclosures are automatically required on the pass-through business return that they are a partner or a shareholder of. So that creates a lot of work on the pass-through businesses. That the newly issued guidance from the IRS did not make changes to that understanding. And so just something to keep in mind as you move through this upcoming filing season, that if you're going to continue to file those pass-through returns, that you're going to be looking to probably have some extra work and extra disclosures there. Great question, Amanda. Does the 1099-K include ACH transactions or cash payment transfers processed via any of those payment processors, Zelle, Venmo, Cash App, et cetera? I believe the answer to that is yes. I believe the payment processors have to, on the 1099-K, report any payment that they processed. So if it's not necessarily like a direct like Visa or MasterCard, type processing, where any type of payment, I believe, needs to be reported on that 1099-K as a payment that that particular processor has indeed processed. So that's a great question to keep in mind when you're trying to figure out how much of your client's income has already been reported on that 1099-K versus how much did they maybe receive in actual physical cash or checks that additionally needs to be reported. So just quickly, next steps. I know we're pretty much at time here, but things to try and start keeping in mind to address these in your projections. Make sure you're updating your tax software now. So I know that a lot of us like to use the handy dandy trick of last year's software in trying to run projections before new software is released. Last year's software, unfortunately, is not going to capture any of these expiring provisions. So that's a great way to miss them in your projections. So you can update your tax software now. I know all of the 2022 softwares are being released and should take all of these expiring provisions into account. That will make it much easier for you to run your projections and know that you haven't missed everything. Schedule your year-end meetings with clients to discuss those changes. I know for me, these conversations with clients about why they're getting much smaller refunds or why all of a sudden they owe money versus getting a refund last year that they weren't prepared for, that conversation goes a lot smoother the earlier that we can have it and make sure that they understand that those are coming. George, you're very welcome. I'm glad it was helpful. Kim, remember to to deduct bank merchant fees from the 1099 income, yes, absolutely. The 1099K does report the original amount charged, not the amount the business actually receives. That is a great point. Thank you so much for sharing that. So you're right. If the 1099 processor, and I know that they're all different, a lot of them will deposit the full amount of the income and then pull their fee out. Some of them will actually take their fee out first and then only give the business owner the differential. So that deposit in those cases to your business owner is less the fees, but the full amount of the income will indeed be reported on the 1099. So that is a great question to ask your business owners. Ask for their payment processor reports to make sure that they know the difference and that you are in fact capturing those merchant processing fees in all of those cases. So I know we're a couple minutes over 12:30. I'll just hold it open for any other questions that feel free to pop them into the Q&A. And while you're doing that, I'm going to stop sharing here and see if I can't get the slide deck to upload for you. But again, I am going to just keep an eye on the Q&A box. So if you guys want to pop in any last minute questions while we're uploading those slides, feel free.
Yeah, and then I'm also going to drop in the actual direct link to last month's webinar. I reposted just the link to the YouTube page, but this is the direct link straight to that webinar. And one thing I failed to mention earlier, so 3 times a year, Insightful Accountant does a Future Forward Summit. And our last one of the year is November 30 through December the 1st. And we're looking, it's not as much tax-based as much as it is kind of looking forward, what to expect in 2023, technology. A lot of what we do is technology focused. So just going to post a quick poll. If you'd like some information on that, just say yes. Otherwise, we won't bother you. And then I also wanted to make sure everyone was aware that sorry, I'm looking up here because I'm copying and pasting. We do have a newsletter that we send out 2 or 3 times a week for tax practice news, and I'm going to put that in the chat as well. And Christine writes, I don't know, 3 out of the 5 articles we post a week come from Christine, and mostly on tax and or practice management. Really would be kind of the 2 major topics that are covered. So I'm going to go ahead and post that as well, if it'll go out.
Thank
there we go.
you.
And then I'll
one more quick. Sorry, go ahead,
yeah.
Gary. You go. Go
I
ahead
was
and
just
finish.
going to say, the one thing that you did not mention, you mentioned it very briefly just in your quick intro, just kind of your company and what you guys do. Especially, I would think at this time of year is really important for you to get that message out so that people do need some assistance or if they need to outsource. So why don't you give a minute on that just so people can make sure they know what you do.
Yeah, absolutely. Thank you. I'll just answer the last couple of questions really quick, and then I will tell you about that. So, Peter, does eBay include sales tax and gross 1099K? I do not know the answer to that question specifically. That is honestly probably more of a point of sale question if you're looking at your client's point of sale system to see how they're processing the payments for sales tax. My guess is that it probably is if they are charging the client for the sales tax at the point of the sale, because again, the payment processor has to include in that 1099K any amounts that they've processed through that system. And then Gary, this question is actually for you. Kathy wants to know if you can include the YouTube link for last month's webinar in the follow-up email that you sent out. She said that that would be very helpful as well.
Yes, absolutely.
Perfect. Great. Thank you. So yes, thank you for the quick opportunity to talk about what we do. So the department.tax, like I said, we white label outsourced tax services. So what that means is if your CPA firm, ABC CPA company, maybe you have some overflow, like you have more returns than you do preparers. Maybe you just don't want to work 80 hours this tax season. Maybe you're missing a tax manager to do some higher level consulting or some more complex returns. We function as a fully white labeled service, meaning we function as if we are part of your tax department. So we don't come in branded as ourselves. We come in branded as if we were just an extension of your tax team. Or functioning as your tax department for you. We do tax return preparation, planning and consulting services, the full 9 yards. And so if you have a need for some overflow this season, if you're feeling like you might be understaffed right now, certainly happy to have that conversation with anybody individually about how we might be able to incorporate as part of your practice.
And they can reach you how?
They can reach me via email as best. I was just going to say, I will pop my email right here in the chat box. So it's Christine at the department. I can type and talk at the same time, .tax. So I just popped my email right there into the chat box. Feel free to email me after the webinar if you have any questions or if you're looking to connect.
Great. Well, thank you so much, Christine. Thanks for once again sharing the wealth of knowledge that you have. Actually, it's funny, as you were kind of winding down, I was thinking, well, it is Thanksgiving next week, and certainly thankful for people like yourself and everybody here who's watching this, who keeps up with what our wonderful government does. And I say wonderful. I do love it, but I also, like you guys, can get a little frustrated with it, right?
Yeah.
But what they do that impacts your lives greatly, right? And we are so truly thankful that we've got people that can stand in that breach and manage that flow for us, because it's critical, certainly as a business owner and as an individual. So thank you.
Absolutely.
Hope you have a wonderful Thanksgiving. Everybody else, have a great Thanksgiving as well. And I'm sure we will see you very soon. Thank you.